Ladies and gentlemen, good morning to all of you. My role is to present theme for the day, what we are going to discuss full day here. Topic we have picked up, export and import of goods and services. Definitely export is very, very important, no doubt about it. The first one is the import of goods. We know on import of goods, till 1st of February 2018, we used to pay BCD, customs cess, and then IGST and compensation cess if leviable. Now this customs cess got replaced by social welfare surcharge. Immediate impact is, earlier it was 3% education cess and secondary higher education cess on BCD, but now it is 10% social welfare surcharge. BCD and social welfare surcharge is not salvatable, not creditable. So what happened? Immediate impact of 7% to the manufacturer and to the service provider, those who are importing goods. Immediate impact first. My second point, it is pertaining to import of finished goods, not the raw material. Import of finished goods, as we have seen our Honorable Prime Minister, it's promoting Make in India. He is saying that we should, prosper, grow, and develop Make in India process. But one disparity which I would like to highlight here, in pre-GST era, when we used to import, we used to pay BCD, CVD, customs cess, and SAD. Manufacturer importing raw material, he used to get credit of CVD and SAD component. And that raw material can be FG also for others. So manufacturer used to get credit of CVD and SAD component, and trader of imported goods used to get refund of SAD component, and that too for specified goods. So if you make comparison, pre-GST era, 12.5% CVD plus SAD of 4%, around 18% credit was available to the manufacturer versus trader only getting 4% refund of SAD, that too on specified goods. What happened in GST regime now? On import of goods, whether you're manufacturer or trader, we will pay BCD, social welfare surcharge, IGST, and compensation cess if leviable. And IGST credit is available to both manufacturer and trader of imported goods. So what happened? Trader was at disadvantage comparing manufacturer to promote Make in India in pre-GST era, but now both are getting same credit of IGST. That is going little contrary to Make in India process. We need to look into this aspect. Coming to the export. Export of goods and export of services. In GST regime, Section 16 of IGST Act 2017 has clearly said that two transactions which is termed as export or zero rated. One is export of goods and services, and second is when supply is made to SEZ unit or developer. These two transactions are zero rated under Section 16 of IGST Act 2017. And how we can do that? There are two options provided in GST regime. Either we can export on payment of IGST, of which refund would be permissible, that is called rebate mechanism. Another is we can export without payment of IGST. So what happens if I'm exporting without payment, being zero rated, I may have paid taxes on my input and input services, of which I can claim refund. And this without payment is possible by execution of LUT, letter of undertaking. This LUT is required for all kind of exporter of goods and exporter of services. We have not seen LUT concept for service sector, but LUT need to be executed even by the exporter of services. This is permissible to all exporter. Online can be filed. Now you need not required to file manually if ARN is generated. That clarity is being provided. But what happened? Who cannot execute LUT? Any person who got prosecuted for any offense amounting more than 2.5 crore rupees. This is what. Now coming to the comparison. If I export under IGST and if I export without payment, what is the comparison and with the disparity? If I export on payment of IGST, of which I will get the rebate, virtually I get refund of input services and capital goods, three together. If I'm exporting on IGST, but if I'm exporting without payment of taxes, I will get a refund, and I will get refund of only input and input services. What happened to capital goods? This is the disparity, sir. This needs to be looked into. You can note down, in case you're not having answer today, we will definitely look forward that in both mechanisms, if any smart exporter will definitely look for payment on IGST, then he can get in cash on capital goods, but that is not available when we talk about without payment of taxes. Coming to the third component. We all know that export of goods shipping bill is an important document. When we are talking about shipping bill, we have seen in recent past that refund was not coming easily in the hands of exporter. And there are multiple reasons for the same. Reason could be that shipping bill need to be tested starting from GSTR 3B, Table 3.1b, followed by Table 6A of GSTR 1, and then it should be mapped with map and match on IceGate. We have seen a lot of, mismatch code is being generated, and those mismatch code may be on account of shipping bill number is not correct, invoice number is not correct, GST number is not correct, amount is not matching, and we were not getting the refund thereof. And we have seen in the past that it was quite difficult to amend. Neither I can revise my GSTR 3B, and if you go back to initial introduction of GST, even I can't revise my GSTR 1, but now the government has eased the process. GSTR 3B can't be revised. But if you want to make correction in GSTR 1 permissible, Table 9 is being given to us. And we can correct such kind of mistake which is evident, noticeable to all of us together. So government is doing their best, but the problem lies. Refund of ITC. Online and manual both together. And I'm sure we got many problem only getting refund whenever we are talking about ITC refund, manual filing. Until 15th March 2018, there was nothing prescribed standardized document for export of services with GST, IGST, or without IGST. Now, if we go to recent circular, which is being issued on 15th March 2018, really giving a clarity to all of us together that in case of refund of ITC, when you're exporting without payment of IGST, there are multiple regions, and those are being clarified and relaxed. It is being stated in the circular that the concerned refund authority should not insist for getting particular document. He may proceed further. So that circular is very much helpful to all of us together. You may look at that circular, and we are going to discuss during the daytime relevance of this circular for getting refund of ITC where export happening without payment of GST. Coming to the way forward. You must be recalling 22nd GST Council meeting held on 6th of October 2017. Government has introduced, which was supposed to be introduced, and we as a trade members voicing since the day of introduction. Pre-GST era, we used to have deemed export. We used to have merchant supplies, suppliers supplying to merchant exporter with no payment. And we used to get exemption for payment of custom duty whenever we talk about advance authorization, EPCG. But from July 1, 2017, everything got stopped. We used to pay and go for refund. Refund was not coming easily. GST Council, in their 22nd GST Council meeting, has liberalized and relaxed the norms. They have given a deemed export benefit, and deemed export only for goods, Section 147 of CGST Act 2017, and deemed export for specified transaction. Supplies against advance authorization, EPCG, EOU. When I'm referring EOU, it includes STPI, BTP, EHTP, and the supply of gold by bank or PSU. In case of deemed export, refund can be taken either by supplier or by recipient. On certain condition need to be satisfied. Coming to the merchant exporter, supplier supplying to merchant exporter, and there's 1/3 of total export only comes from merchant exporter. 1/3 of total export I'm referring to. Now, with this 22nd GST Council meeting, government has relaxed so many norms, exemption provided whenever we are importing against the credit script or the advance authorization or DFIA. We need not require to pay and not required to go for refund. So working capital block was resolved. Deemed export got extended. Now this supplier supplying to merchant exporter at the rate of 0.1%. Very well suggested, but now the question comes, and question H, which I'm posting to Srivastavaji. Sir, what happened from 23rd October 2017? This particular scheme was launched that any domestic supplier can supply at 0.1% to the merchant exporter. So domestic supplier can claim refund as inverted duty structure because he may have, paid taxes on inward at a higher rate and exporting at 0.1%, so he may go for refund of inverted duty structure. What this merchant exporter has done, they have used the mechanism of export on IGST. Export on IGST. Now, they wanted to get refund of IGST, but recent clarification, which is being issued on 23rd January 2018, clearly saying that merchant exporter cannot follow the method of export on IGST. They have to follow the method of without payment of GST. But 3 months they have followed the same, paid the IGST either through their e-credit ledger or cash ledger. Now what happened to this money? If this is not permissible, at least allow re-credit of this particular amount which is paid towards IGST. Maybe that may be looked into. Coming to next component, Eba Bill. We all know Eba Bill applicable for domestic transaction. But is it required for export and import? Of course required. So what Rule 138 says, any registered person causing movement of goods having consignment value more than 50,000 must furnish specified particulars of Part A, Eba Bill 01 on common portal. So if I'm exporting from my factory in Noida through Nhava Sheva, and it's going to Germany, so we have to generate the Eba Bill from my factory to Nhava Sheva. But this can also further be relaxed in case e-sealing is being done under the government authority. When e-sealing is being done in the factory, why we are insisting for the Eba Bill? My consignment got sealed. This may be relaxed to provide ease of business. This is one suggestion which I'm giving from Eba Bill perspective. Now coming for export of services. So there are 2-3 important points which I would like to highlight for export of services. The first one is intermediary. And I would like to request you if you can throw some light. Intermediary services. What happened? I'm creating an example to explain to all of you that let's say I'm intermediary, Indian commission agent. and I'm giving services to my foreign supplier situated in Korea. And this foreign supplier wanted to develop Indian market for him. And I'm being paid as a percentage of turnover, import made by ultimate customer. These are called intermediary services. Now, sitting in India, I'm giving services to foreign supplier in Korea, developing Indian market, I'm being paid a consideration. Whether GST applicable? Answer is applicable from 1st October 2014. This provision is being picked up only from POP rules, Place of Provision of Services Rule 2012. GST applicable. Now just think of what happened to me. I will charge GST to my foreign supplier. What foreign supplier will do of GST component? So that is becoming incompetitive in my pricing. In this particular case, I'm getting foreign exchange and GST made applicable. Reverse the example. Let's say Indian supplier is contacting foreign commission agent in Korea to identify market in Korea. Now he is giving services to Indian supplier. Whether reverse charge applicable? Not applicable. It is location of supplier in terms of place of supply. In this case, foreign exchange is going out of the country. Still GST? Not applicable. Contrary to the economic policy, where I'm getting foreign exchange for the country, why should be chargeable to GST? And in that transaction, my recipient, who is a beneficiary of my services, situated in outside India, Korea. So this should be looked into. We have to make the law and make the law conducive manner that help us. Tourism and hotel industry, they are having much concern that for tourism and hotel industry, we are giving services to foreign client, paid in convertible foreign exchange. What happened? GST applicable. So what happened? Being travel agent, I'm booking a ticket for you and you're traveling outside India. GST applicable, right? But ultimate consumption of service will happen outside India. If GST is a destination-based consumption tax, why such transactions should be made leviable? So what happened? This recipient who is taking services from Indian counterpart, he will take services from Nepal or Bangladesh or Sri Lanka. So our business is moving from our Indian territory to outside part, maybe looked into. Coming to some of the DGFT related and export related issues. So one is that payment of CVD whenever export obligation is not fulfilled against advance authorization and EPCG. In pre-GST era, we used to pay along with interest and we used to get the credit of CVD component. What happened in GST regime? If I have not fulfilled the export obligation and I have to pay differential, credit mechanism is not provided. Coming to the second point, that SEIS, Service Export India Scheme, is not given to STPI unit. Why it is not being given to STPI unit when it is being given to SEZ unit? And STPI unit is ultimately exporting. This must be given to them. Coming to the third component, SEIS benefit is not allowed if I go outside India and give services at the client's premises. SEIS scheme says it should be provided from India. I'm location in India, but going to my client premises outside India, why SEIS benefits should not be given? And there's a disparity coming out, may be looked into. Coming to the last component, that credit script, sale of credit script. Until 13th of October 2017, rate was prescribed 5%. Now relax. So with this, I am summing up my theme presentation. Thank you. Thank you very much.